Good morning, everybody. Welcome to our video conference from Sereducacional to talk about the results referring to the first quarter of 2025. This web conference is being recorded and you can rewatch it on the website of the company, aisereducational.com. This presentation is also available for download. I'd like to inform that all participants who are going to be only watching the presentation, and after we're going to start a Q&A session when more instructions we are going to be giving. Before we start, I would like to reinforce the declarations here has a base the beliefs of Ser Educational, taking in consideration about information about the market. These may include uncertainties and macroeconomic tendencies, which may occur or not. Investors, analysts, and journalists should take in consideration that events connected to macroeconomic, the segment, and other factors may influence the results influencing it in different ways. Taking the prospective considerations into consideration, we're going to have today Jânio Diniz, CEO, João Guiar, CFO, and Rodrigo Alves, IRO. We'd like now to give the floor to Jânio Diniz, CEO of the company, who's going to start the presentation. Please, Mr. Jânio, you can start. Good morning, everybody, and thank you for joining us at the event to announce the results for the first quarter of 2025. Considering, as you may have noticed, the material published last night, the results in the last quarter were very positive, with the highlight being the growth of more than 16% in students intake in higher education, marking our consecutive years of uninterrupted growth. Likewise, the students base in the category also grew by 15% compared to the first quarter of 2024, surpassing the historic mark of 185,000 students. This operational growth was reflecting the important financial results achieved during this period. We recorded the highest adjusted EBITDA and the highest net operation cash generation post-CAPEX since our EPO. This quarter adjusted EBITDA margin is the highest since the first quarter of 2017, when we had a significant base of FIES students, a program that today represents less than 4% of our total undergraduate students base. These record results are significant not only because of the numbers, but because, in our view, they change the company's level of value in the market. The results demonstrate that we have managed to create our operating leverage such that the additional revenues generated this year are largely converting into increased nominal EBITDA and profit, which is the main conclusion we draw from these quarter results. This phenomenon is most clearly illustrated in the two graphs below in slide 5. The first graph shows our success in consistently increasing the number of undergraduate students per on-campus unit, reaching a level of almost 3,000 students per campus, given that we have had 5 new campuses in operation for less than 24 months. At the same time, we have managed to significantly reduce our financial leverage to 1.35 times net debt adjusted EBITDA, bring us ever closer to our goal of achieving adequate financial leveraging, especially in a scenario of high interest rates. As a result, solid profit generation, a main revenue stream, classroom teaching, which has recovered the operational efficiency promised to the market, with high occupancy rate for buildings and classrooms. In addition, we maintain a robust cash generation digital education business. Since last year, we have gained a significant portfolio of places on courses, positioning us as one of the main players in the market with a large number of places available in these area classrooms. As low in slide 6, in our necessary position over the last 12 months has included the addition of 480 new medical places, 360 of which came from ordinance issued by the Ministry of Education, MEC, and 120 from court injunctions which have not yet become final. They highlight 2 relevant facts this quarter. Firstly, the accreditation of the course in Maracanaú, authorized at the end of March, which began class in April with a full class. Secondly, we saw solid demand for our vacancies in the recruitment process, resulting not only in the vacancies offered being filled, but also a robust average ticket for the course year we analyze more later. We currently offer 1,000 medical placement of 92% compared to the first quarter of 2024, contributing significantly to the quarter's results and allowing us for continuing revenue growth as places mature over the next 5 years. We emphasize that we are still waiting for the approval of a further 106 places this year through requests for increase in places and injunctions, as well as expecting new accreditations among the 21 proposed via the Mais Médicos 3 public notices, which are waiting to release of results by the MEC. Sereducacional, therefore, reinforces its relevance as a trainer of doctors in a country that lacks professionals in this area, especially in the north and northeast regions we operate. Our courses received 100% satisfactory evaluations with the INAD for established courses in grades 4 or 5 in the accreditation visits for new courses in the last 12 months. Speaking of quality, in slide 7, we present an important update on the subject based on the data released last month by ENAP on the 2023 INAD, which mainly assessed courses in the health area. It was a cycle of significant achievements for us. With the expansion of a range of courses in this area, we saw a 53% increase in the number of courses assessed. We managed to maintain a high rate of courses with satisfactory evaluations compared to the previous periods. Also remembering that the 2023 harvest was one of the most impacted by COVID and achieved an IDD, student development indicator, for 2.2 for hybrid teaching, which probably represents the best indicator for effective learning among the companies listed. We believe that we are moving in the right direction, and we believe that we are high track with the unique value proposition. This proposal combines strong and recognized brands and modern high-quality academic model with its ubiqua, with privileged location and excellent infrastructure in our education institutions, as well offering courses in high demand competencies. With these results, we will continue to improve our academic model, looking for innovative ways to increase our students' ability to learn, thus perpetuating a value generation of our education institutions and reinforcing our value proposition for students. Moving on to quarter results, let's go to slide 9, where we present the students' intake data for the first quarter of the year. As you can see from the figures on this slide, we had a solid increase in the intake of hybrid education students, which resulted in a significant increase in the overall intake of undergraduate students for the 4th consecutive year, as I mentioned in my initial comments. This growth was partially offset by a reduction in digital teaching, which was to be expected, considering that the modality faces intense competition in the market with prices below those we are currently practicing. However, in hybrid education, we are not only saw solid demand, but also more favorable pricing behavior in the market. This allowed us to successfully implement the Solidarity program throughout the funding cycle, as well applying an interesting price adjustment for both new students and veterans. Please, let's go to slide 10, where we detail the growth of our student base. Thanks to solid growth in hybrid undergraduate students intake, combined with an excellent re-enrollment season, we were able to expand our total undergraduate students base by 10%. We would highlight the 15% growth in the hybrid student base, excluding the medical course compared to the 2 periods, as well as a 26% increase in the medical course student base due to the addition of the new places mentioned above. This is a significant result, as allowed us to resume occupancy of our buildings and classrooms, demonstrating our ability to recover operating leverage. This translated into more expressive margin increases, as seen in the quarter results. On slide 15, we show the present evolution of students base by area of knowledge, which continues to reflect our strategy for focusing on offering courses in the areas of health and law, which are courses with greater demand in the market and provide a higher average ticket. This year, we reached the mark of 64% of hybrid education students enrolled in health courses and 45% of the total students base. This movement, which began a few years ago, is now generating the expected results, reinforcing our operational resilience. This resilience is due not only to the area in which we operate, but also to the fact that we have a significant proportion of students in the first 2 years of the course, the result of consistent growth in students intake and student base over the last 4 years. In slide 12, we present the evolution of the average ticket, which is mentioned earlier, benefited from the focus on health courses, the expansion of places on the medical course, and the favorable economical environment. We would highlight a 20% increase in the average ticket for the medicine course. This is mainly due to the fact that courses accredited in the last 12 months have a higher average ticket than legacy courses due to the higher prices in markets in which they were accredited. In higher education, the growth in the average ticket was mainly driven by the Ser Solidário program, which Agar will detail later, along with the price adjustment for inflation. This growth was partially offset by punctuality discounts, as more students are paying by the fifth, as well as an increase in pro-uni students. These factors, together with the reduction in the distance learning students base, contribute to an increase in our overall average ticket during the period. This result has provided very positive, as João Guiar, our CFO, will now present. Thank you, Jano. Hello, everyone. And once again, thank you for attending our results conference. In slide 14, we present net revenue for the quarter. The growth in the students base and the average ticket, as stated by Jano, enabled us to achieve substantial revenue growth of 20%. This is a significant result for the period without considering the effect of the Ser Solidário program, would still have had a growth of around 15%. This shows that even on a like basis, the organic growth of the student base, especially in the medical course, was the main driver of the increase in net revenue. Slide 15, we present our adjusted IFRS EBITDA, as well as adjusted EBITDA, including non-recurring effects such as interest income from tuition fees and minimum rent paid, which the traditional report. As highlighted by Jano, these were records for first quarter since our IPO. As you can see from the graphs, the results were very positive for the period. These results were achieved not only by the positive intake on re-enrollment cycle in the quarter and the expansion of medical places, but also by the success of real operation turnaround carried out over the last few years. This has included solid cost control, difficult decisions such as the return of the capital of the summer. This allowed us to this year with a very controlled cost expenditures, enabling us to expand our margins in these 3 quarters. In addition, this quality of results was not only with the cycles, the capitation of students, but the success of this turnaround operation, enabling us to expand our margin. This includes solid cost control, like the giving back of real estate, optimization of portfolio of costs, reposition of our brands, and many other programs we implemented these last 3 years. In this, implement us to start the quarter with a cost structure very controlled, possibilitating the expansion of brands. On slide 16, we show the present exact details of Ser Solidário program. As you can see, it was being made available to all hybrid and graduate students, the exception of government programs, ProUni and FIES, and the medicine course. As shown in this table, Ser Solidário replaces the tuition discount we offered the last year, introducing the installment payment of the tuition fee and the actual tuition fee in the end of the course. This implementation was successful. In the economic terms, we recognized 23 million in additional net revenue and 14 million of adjusted EBITDA for the quarter after AVP and PDD adjustments. This was crucial to increase our operation cash generation in the medium term, as well as making our results healthier and more consistent following this successful implementation. Now, moving on to slide 17, we present our net profit and adjusted net profit, excluding non-recurring items. As you can see from the graphs, not only did we reverse the accounting loss into profit, but we had also a quarter with a low impact from non-recurring effect. This reflects that we said at the conference in March about the fourth quarter results. In addition, the demonstrated Demonstrating the effects of the operation optimization process we completed last year, we were able to present results with a lower incidence of non-recurring adjustments and increase our operating cash generation. Another important point in relation to accounting and adjusted net income is the net margins, which were quite significant. This is all the more relevant considering that despite the improvement, we still have fully achieved our goals of reducing financial leverage. On slide 18, we present our net operating cash generation and post-CapEx, which, as we can see, showed significant growth this quarter. This is yet another record for the period in nominal terms since our IPO, whereas materializing a solid improvement in the year converting of EBITDA in cash compared to the previous year. This improvement in results reflects not only the turnaround process that we have discussed extensively on this call, but also an important improvement in the punctuality of students' payments that we have observed since 2023. This improvement in our students' ability to pay is linked to the favorable economic dynamics in the markets in which we operate, as well as a series of measures we implement to improve the collection of renegotiation process with students. This has contributed considerably to improve our cash generation, while at the same time we have reduced the discounts granted to defaulting students without any major impact on the re-enrollment process. This is an important result that we have achieved and which is helping us decisively to achieve our goals of reducing debt and financial leverage. The improvement in our management of credit operation is reflecting our PMR, which even with the implementation of the Solidarity program in the quarter, which in theory would increase the relative size of our accounts receivable on the balance sheet, had the opposite effect. This is mainly due to the improvement of the punctuality of tuition payments. As a result, both our PMR and our PMR ex-EFS showed another quarter of decline, a pattern observed since the first quarter of 2022, as shown in the graph, even with the introduction of Solidarity, which being an installment program, would naturally increase our PMR. This shows that the company is on the right track, increasing its operational efficiency, generating cash, and maintaining adequate provision for losses. With that, we move to slide 21, which highlights the substantial reduction in our debt and financial leverage this quarter. We are getting closer and closer to achieving our deleveraging goal. And after reaching these targets, it will be possible to increase the payment of dividends to our shareholders. This payment was already being resumed this year with the amount of 90 million scheduled for May 16. We are very confident in the execution of a plan and are consistently managing to reduce our financial liabilities this quarter, consolidating our position as one of the least leveraged companies in the sector at this moment. And before concluding our comments, as we have the results where we show our evolution of CapEx, which fell this year compared to last year. This reduction was due to what I believe to be a one-off effect, since we had a gap between the works carried out last year and the start of work, especially the expansion of the Boa Viagem unit in Recife, with the implementation of health laboratories due to the maturing of new courses in the area of knowledge, which are scheduled for 2025. Those were my comments, and now I'll give the floor back to Mr. Jânio to make his final remarks before the question and answer session, the Q&A session. Thank you, Mr. Aguiar. We now move on slide 23, which is the last slide in this presentation. After having updated you on our new mission, vision, and values in the March conference call, this slide summarizes our strategic objectives, which also have been updated in line with the achievements of recent years, such as the successful implementation of our operation optimization plan and the expansion of our medical school places base. We are entering a new growth cycle where it will be crucial to maintain our operational financial discipline. At the same time, we are resumed organic growth achieves, especially in higher education, with the opening of 5 new units between last year and this year. We will continue to focus on markets we know. Our goal is to maintain a lean course portfolio with emphasis on health courses, strengthening our unique value proposition for our students. We will invest in the best experience for our students developing our continuing education ecosystem in courses that are high demand in the market. Finally, we will continue to expand our base of places of medical courses, with injunction still being processed for approval and the expectation of receiving more places through the Mais Médicos 3 program. This will maintain a solid strategy focused on a gradual and well-controlled expansion of our offer in new markets without losing focus on generating cash and reducing financial indebtedness. In this way, we aim to make our company increasingly profitable, offering quality education in a sustainable way and generating value for Brazilian society, stakeholders, and the society. Thank you very much. Now available for Q&A session. Thank you. We're going to start now our Q&A session for investors and analysts. If you want to make any questions, please clicking raise hand. If your question is answered, please you can take clicking again on lowering hand. Our first question comes from Mrs. Mirela Oliveira from Bank of America. Please, you can proceed. Good morning, Jane and João, Rodrigo. I have two questions. First, about the medium ticket on medicine courses. We saw growth in this quarter. Could you comment on the strategy on the courses we have already? It is a strategy of repositioning in the market, reposition of the brands, or you're focusing a specific brand. I would like to understand more this movement. And the second question is about the competitive landscape. If you could comment on what you can see on long distance teaching and on-site students, if you see this strong demand after this first quarter. And what do you think it's helping you on the enrollment of new students? Thank you very much. Thank you, Mirella. I'm going to talk about the medicine ticket, and Johnny is going to talk about the competitive landscape. What happened with us is that when we started with the courses on the new market, these markets had already average ticket that was higher than the markets we are already present. So the biggest part of the increase of a ticket was offering new markets with a higher ticket. When we go to tickets that we operate, there are two movements that we consider important. First, the movement of maturation of the basis, more students going to the sixth period of the year. With an increase of more practical classes, you have to increase the price of the course in 20% with more practical lessons. And there is the reposition of price in some markets we operate, especially big markets like Recife. With that, we generated this increase of average ticket, but the most part of that was we starting new markets where we had a higher ticket, and we had already two harvests on those markets. Comparing that, they have a big impact on the average ticket. And about the competitive landscape, Mirella, on-site is already very competitive and more controlled on price, and we were able to cover the inflation in all those courses, and we still have a great demand as with the new courses. And in long distance internet studies, it's very competitive, and we believe it's going to stay like that. When people don't know how the guidelines for the long distance students, we think we're going to stay like that. The market is more centered on the courses, hybrid courses and on-site, but long distance courses, they still have this effect. Thank you very much. Our next question comes from Mr. Mauricio Cepeda from Morgan Stanley. Please, can start. Good morning, Jânio. Thank you for the space. When we talk about courses, you see there was the biggest leverage on the margin increase. We would like to understand this benefit was only the leverage, operational leverage, or the mix that's coming from medicine courses. And talking about medicine, on the course of medicine courses, how do you see uh, the REM, the leveraging medicine courses? There is the you have an increase of revenue, but they're going to have an increase of costs. What do you see it can happen there with matching of medicine courses and this relation revenue and costs? And second question is about the intake of students. You saw an increase in intake of students and would like to understand if it was homogeneous around Brazil, if this has to do on you opening new campuses, how much it would be the organic growth comparing the old campus and the effect of the new campuses. Thank you, Mauricio, and for your questions. Good morning. Let's talk about the margin and, and revenue and cost margin. This is a long-term work. We are focusing on that and started to make this process in 2023. And this comes from three main items. The main points are giving back the real estate, where you use more the real estate we have, we kept, so we lower costs, giving back those real estate we're not using in totality, impacting a lot our costs in renting and costs that come with the real estate, cleaning, finance, taxes, and so on. And second point is the insertion of Ubiqua on those parts of all levels of our teaching. Ubiqua brings the reduction of costs with teachers, the interaction of digital learning, distance learning, and on-site learning. This reformulation of our systems brought lots of increase in revenue. And more we look at the structure of back office, understand which would be the best structure for process, routines, automatization, people to provide the rentability of our courses, delivering the quality studies for our students. And we're focused on these three pillars. The other point on medicine courses, every new medicine course has a lower cost because in the beginning you have more theoretical lessons, lectures, and the end with the progression of the course, you start using more labs, you have more costs on structure, and then averaging these costs in 50 years, you have a change of 50% on the cost. On this cost, on the new courses, through the process of the increasing of medicine courses, there is a component, what is the 10% of the revenue you have to give it back for the municipalities, which lowers this final margin we have on the medicine course. Like in practice, this is a very strong margin, and we're not going to have increment of the costs. Looking on the new structure that say we're able to install on new student places, I believe that we're going to keep a very good margin of revenue costs that we have already. Related to your question, we had a very uniform growth. Only a few points on this management, we were more conservative on price. So we are following the market to see this development. The whole market and those units we opened, they're not relevant yet on new enrollment. This growth Marcelo, sorry, Mauricio, was done on our units we had already. The new units, they have a very low impact on our revenue increase. A new unit we opened, we went really well. The other ones, they have a conservative growth, so they're not impacting our results. Thank you very much. Thank you, João and Aguiar. Our next question comes from Mr. Luca Marquezini from Itaú. Please proceed. Good morning, everybody. Thank you for this presentation. We have two questions. First, about Ser Solidário. There was a first quarter where you had this program as a full. I would like to understand what's the size of this program. Looking ahead, do you think there's still possibility to increase this program on the student base? And then would like to have a follow-up on the last question on the cost aspects. One of the main drivers of reducing costs was giving back real estate. Looking at you can still give back more real estate, reducing costs on rent, or how this will be our questions. Thank you very much. Look, I'm going to answer the first question. João Guiar is going to answer the second. Ser Solidário impact 80% of our enrollment base. And that's our maximum result because students from ProUni and FIES, they don't have Ser Solidário. And there are more or less, this 20% of students on medicine courses. From now on and ahead, Ser Solidário is going to have the same size. To talk about real estate, we still have a less round, but it's not going to be very relevant. Obviously, we're going to be observing new possibilities to restructure our real estate in occupation of space, new negotiations on our rents we have. We are paying attention to that, to our real estate, but what we still have to do, we still have a few things to do, but they're not going to impact in a great way our results. About the other costs that we are talking about, we go through steps. We do the first adjustment, where then we go trickle down until you have this panorama where you're going to improve parameters. But on our view, we're going to be always looking at this perspective on efficiency on cost on every unit, on also on back office. This contest on new improvements on course will be always part of our management. You're going to be always part of the results. But we already advanced a lot in this aspect. Thank you very much. Our next questions come from Mr. Marcelo Santos from JP Morgan. Please proceed. Good morning, everybody. Thank you for answering my questions. First question is, I'd like to go deeper on discussion of our friends on costs, looking at gross margin. You have the restructure of back office, Ubiqua, and real estate. I would like to understand more. When you look at the revenue, you had a great increase and the cost increased very little. This due to time or the level of cost. I think this would be would stop there, reducing costs, but I would like to understand how could you improve the costs and what could be the effects there. And for Aguiar, when you get into your level of leverage, the dividends could be improved. How is that going to work? I'm going to answer the first question, Aguiar, answer the second. A part of the increase of gross margin that's permanent, that there's increase of courses. A part is about time. That a big part of this quarter, we didn't have lectures. So a big part of the cost now we don't pay that on the first quarter. This effect of expansion of margin that we have the revenue of Ser Solidário. On the other side, the maintenance of our cost structure, because that's a period with less classes. So this has an impact on that. This change on this seasonality is permanent. So we have to think that in the second quarter and third quarter, fourth quarter, we don't have this expansion, this increase of margin on the complementing that we did on quarter on the fourth quarter. Comparing all of that, we can have this clearly. We have some seasonal aspects on the odd quarters, and the other quarters, it's permanent because you have to consider the semester perspective on this cycle of teachings. Complementing this point, when you have a growth of the enrollment of students, you keep this growth during the whole course. This is also a very positive aspect. And having a healthy students base on the first and second year of the course is a result that we set on our enrollment. We are increasing our rate of enrollment since the worst moment we have in the pandemic. This increase year after year, you have better revenue, and this accumulates with time. This is also a very positive point on our students base, and you carry this out through the whole course. Thank you very much. About leverage, when we are in this period of more leveraging, financial leveraging, 2019, 2022, we commented that the health leverage is this financial leverage 1 and 1.2, maybe 3%. But we're going to be passive there. We want to be in balance with EBITDA. When we talk about health leveraging, financial leveraging, you have to look at where is this leverage, short, medium, or long term. So our leverage, financial leverage, is very healthy because it's only 0.3% our EBITDA, but this is also long term, and our goal is that. Thank you very much. Our next question comes from Mr. Renan Prata from Citi. Please proceed. Good morning, everybody. Thank you for the space today. I have a quick question on cash generation, operational cash generation. How do you see the generation of operational cash for the year? On this quarter, we had a big step on deleveraging, on net debt, and on capex. As Aguiar said, we have a reduction on this quarter. I would like to understand what do you expect for the year on the capex. Well, when we talk about operational cash generation, what we do is our enrollment is improving, even with Ser Solidário. Ser Solidário promotes cash generation only medium long term, but you have the incidence of the students that pay our courses. We have improvement of our payment process and default process in students with process. And these changes have a very positive impact on the operational cash. And today we can bring students that in the past they were not able to pay on time with being punctual, and they're going to be back to do negotiations on the next month. And today we have students that are coming earlier, and we have the opportunity for them to pay these fees in better ways for the student and for us. This is one of the reasons where our average ticket doesn't show elasticity, because this brings average results. but this brings a very good impact on operational cash generation. And this process of turnaround, this generates impact on everything we do, on payment models, buying, our process of buying, procurement process, and this brings impact strongly on our operational cash generation. And the value of our gross debt, and with less real estate occupation, we reduce costs, impacting our operational cash generation. For the year, we hope for, we have to look at many macroeconomic aspects, debentures, and we did 2-3 years ago. They're going to impact at the end of this year, next year, but I take this seasonality and those macroeconomic aspects, I think we have this operational cash generation strong, impacting on the reduction of our financial leverage. Our capex every year have the review, even with the initial planning, you have our building sites that you're going to consider this year. The review when to start those building sites and how they impact the enrollment possibilities. So we got this beginning of building sites in the beginning of 2025. We have to understand how this is going to impact our enrollment, and how we would redirect these building sites. We would start in January, and we're going to start this later. As I commented on the results, I understand that for the year, we're going to keep our capex in a very good level, as we were able to demonstrate. Taking the effort we had last year on the medicine course, we're going to keep a capex. There's very good historic results, taking into consideration the improvements we have done on our real estate and the structure we have to deliver for our students through the journey they have in our institutions. Thank you very much, Aguiar. Our next question comes from Mr. Samuel Alves from BTG Pactual. Please proceed. Good morning, Rodrigo, João, and Jânio. Good morning, everybody. 2 questions. First, I would like to have a follow-up on the medicine ticket. Could you tell us what's the range ticket on medicine courses you have from the lower to the highest ticket? That's the first question. The second question is about the allocation of capital in M&A. João commented that you have the goal on financial leverage. The company reaching this level, this better level on financial leveraging, how do you see the appetite on M&A in medicine? How do you see the space for merger and acquisitions in this sense? Thank you for questions. About the medicine ticket, we have 3 points that are very important to be talked about. First of all, as we said in the beginning of our speech, we have the harvest. We have new harvest on these medicine courses. When we start these new harvests and you give it back on the inflation on the medicine courses, you start having a value that gets to the average ticket on the less harvests. The second point is harvests that are more ripe. You have the income of new on these students on the working market, so where you have to build them on the new harvest of students. The most recent harvest, the last year and this year, we have the highest average ticket. Looking ahead, this average ticket is going to be close to what we are working to the new students on these last 2 years. And on the size, the new students, the lowest prices are 9,000 reais. And for all the students, the highest tickets are 13,000. So and there is the difference on the markets, and they are created according to the practice in each market, every geography. We don't put prices above the geographies. So we work in the average ticket by each geography. And duration of capital, as Jânio and João commented, our main focus is on reducing our financial leverage, reducing our debt, getting to 1 time our EBITDA, and this came from 2.8 times. And starting there, our idea is to concentrate on organic growth. We have 5 new units operating since 2024 till now, 3 new this year. The idea is to evaluate the performance of each unity, having our ceiling of costs, open new units next year. And with that, have this path for organic growth, in our view, can be very interesting on capital acquisition. On M&A, we are more reactive. The idea is that we analyze opportunities, good opportunities, but the main focus is reducing our debt, payment of dividends. That this year we did the first movement after 4 years not paying dividends. Last Friday we had the first payment of dividends, and then have the organic growth after that. If you can list our priorities on capital generation. Thank you. Have a good day. To make questions, you just raise your hand. Let's wait. To make questions, please click on the button raise hand. The Q&A sessions is concluded. I would like to give the floor to Mr. Jânio Diniz for making the final considerations. I'd like to thank you all for participating in our results release. If you have our investor relations department, it will be available to provide further clarifications. Have a good day. The video conference from sereducacional is closed. Thank you for your participation and have a good day.